Sustainability has become an essential part of business, not just a trend. Investors, regulators, and customers want clear information about how companies perform in environmental, social, and governance areas, often called ESG. By including these sustainability measures in financial reporting and planning, companies can better connect their profitability with long-term strength and resilience. This integration responds to growing investor pressure since funds focused on ESG represent vast amounts of global assets. It also meets regulatory demands, like mandatory climate disclosures in places such as the EU and the US. Additionally, addressing climate and social risks helps reduce operational costs and protect company value. Companies with strong ESG profiles often do better in the market compared to their peers. Some key sustainability metrics to track include carbon footprint, which covers total greenhouse gas emissions, energy efficiency, measuring energy use per output, water usage and waste management, which show how effectively resources are used, social impacts like employee diversity, health and safety, and community involvement, and governance factors such as board diversity, anti-corruption policies, and compliance ratings. All these elements contribute to a more transparent and responsible approach to business that supports sustainable growth. There are several frameworks that help integrate sustainability into financial reporting. ESG scorecards align sustainability goals like carbon reduction with financial targets, such as cost savings on energy bills. Triple bottom line accounting goes further by measuring profit, people, and planet together to give a holistic view of performance. Integrated reporting combines financial and non-financial data in one report, a practice used by companies like Unilever and Nestlé to boost transparency. Real-world examples include Unilever, which ties sustainability goals directly to how they allocate capital, investing in low-carbon supply chains, Microsoft, which uses internal carbon pricing to guide budgets, and Patagonia, which factors environmental impact into pricing and cost structures. This integration brings clear benefits. It attracts investors who prioritize ESG, improves operational efficiency by reducing waste and energy costs, and strengthens brand reputation through enhanced customer loyalty. However, there are challenges to overcome, such as the complexity of gathering accurate sustainability data across global operations, the lack of standardized ESG reporting frameworks, and the difficulty of balancing short-term costs with long-term benefits. Looking ahead, AI-driven ESG analytics will likely automate much of the reporting process, and carbon accounting is expected to become as routine as financial accounting. Companies that don't adapt risk losing relevance in a market that increasingly values sustainability. Ultimately, integrating sustainability metrics with financial planning is critical for building resilience and maintaining a competitive edge, turning sustainability from just a compliance task into a strategic driver of growth and trust. Companies that successfully integrate sustainability into their financial reporting and planning will not only protect their financial health but also establish themselves as leaders in a market that increasingly values responsibility and transparency. This approach helps build trust with investors and stakeholders who are demanding more accountability on environmental, social, and governance issues. Embracing this integration positions a company to be resilient in the face of regulatory changes and evolving market expectations, ultimately driving long-term shareholder value in a global economy where sustainability is becoming standard practice.